Welcome back. As promised, let's invite Jyotivardhan Jaipuria from Valentis Advisors to talk about the markets and the way forward. Jyoti, can't not begin this conversation by getting your view in on cement. So first, take us through what we've seen right now. Another step towards consolidation. The big two are only getting bigger, the Adani Group and the Birla Group in cement. What does this mean? And is there any opportunity, any play, large cap, mid cap, south-based?
Yeah, so Reema, if you think of the few conversations we had in the past on cement, we have been very clear that one of the main reasons why we like cement is consolidation in the segment, and we will continue to see consolidation. The way we are playing it is that two ways you can play it, right? The people who will acquire, which are all the large companies, or the people who get acquired. We think there's more value actually in buying the people who get acquired, because most of the deals like this still probably happened at around $85 a ton. So we think most of the deals will happen between 85 closer to maybe even $100 a ton. And there are a lot of smaller companies trading at lower than that. Then that's where, you can make a bigger bang for the buck in terms of share price. Otherwise, of course, some of these large companies which are buying out and they'll be big, that will be another way to play it long term, because they'll continue to be winners in the space.
So you're saying that companies like Ultratech Cement, despite the rally that we've already seen, Jyoti, there is still more scope for these names in the longer term?
See, the longer term, Sonia, the scope is there, because essentially what will happen is, as there's a consolidation in the sector, and we've seen this across the world, after this consolidation, let's say the top 5 players end up owning 75% of the capacity. There are a lot of pricing discipline which comes in. And after that, you stop seeing prices not going up. What we've seen in the last 6 months in the cement space is, one, the demand has slowed down. So because, after the model code of conduct came, tenders from the government started to slow down. And second is, pricing has been lagging, and we have hardly seen a price increase for the last 6-9 months. So this whole consolidation helps to, seal up that pricing. So now in South India, you have the two biggies who've taken, two of the smaller players. So to that extent, probably there'll be a bit more consolidation happening in South, and we'll see some pricing discipline coming in the South also. So I think overall, over the next few years, it will be a sector where you'll see a lot of demand growth and, better price discipline, simply because it will be a more consolidated sector.
Okay. Do you still maintain that it's the domestic focus, domestic oriented sectors that one should look at? Because it's been a theme which is running in the market and stocks have done very well. So from here on, where is the opportunity? Have you made any recent purchases?
Yeah, so we continue to stick to that. We are looking at some of the, more external facing, like we had added pharma a year ago. And now we are looking quite closely at actually the chemical space, because that sector lagged for the last 18 months. We've seen, some drawdown of the inventory at the dealer level, but I think it's still, probably 3 to 6 months away before things start to look good there. We generally tend to buy stock prices early, so maybe in the next quarter, we'll be looking at adding to cement in our portfolio. The other thing which is more domestic facing, which we've been buying, has been the banks. So banks have been laggards in the last 12 months. And the banks is one space which actually in the whole market, which is not very cheap, the banks are looking relatively much cheaper. So there are temporary problems, but because you're getting them at good valuations, banks is one space where we've been adding to our positions.
Would you be adding at all to IT? Because IT seems to be a laggard, underperforming. But at some point, is there value there?
So yeah, Sonia, we've tried. We kept looking at IT. It shows up on our screens all the time because, it's underperformed, it's underowned, it's, undervalued now. But, we're still a little skeptical of the demand environment in IT. And that's the reason we've not taken a meaningful position there. But it is something which, I think at some point, all of us will adapt to IT very quickly, because when the turn comes in the sector, then, because it's been so underowned and it's done so badly, you probably have some space to do well. But one other concern on IT I'll point out, and this is something which we've been discussing a lot with the experts, is the AI. And will AI mean that for the Indian IT companies on a very permanent basis, it means that the demand environment will be slow, because you probably need lesser number of people to do the same work once AI becomes more mainstream.
And what is your view on that? Whether, yeah, go ahead.
So frankly, our view is that AI will start hurting. So on a longer term basis, it is the Indian companies will have to change, what they're doing. But, in some sense, the whole outsourcing model will probably get into a bit of question mark. We'll have probably slower demand coming in the outsourcing model. So to that extent, some of these stocks and the sector itself will probably see a bit of derating because the demand environment for IT outsourcing will be slower for a longer time.
So a quick, we're running out of time. So if you do play IT, it's just a tactical call. Structurally, long term, you're not very bullish on the prospects of Indian IT companies.
So, they'll have to reorient themselves because they'll be working IT. So what they'll probably have to do is that the volume will go down, but, your value will go up because what you end up doing is, higher value addition work in the AI space. At the same time, the way they kept adding people, they'll probably keep adding much lower people in that period.
Okay, Jyoti, we'll leave it at that. Thank you so much for joining us. Appreciate your time here on CNBC TV 18. By the way, the market is doing very well. Don't